Welcome back, ladies and gentlemen, to another episode of What's on Your Mind. I've got Jason McDonald and Ben Berggreen joining me on this episode as we dive into their perspectives on the financial markets and also a few of the ideas that they've been looking at for their own portfolios as well. So, gents, it's great to have you on the show once again. Always a pleasure. And I think we'll just get stuck in this episode. And Jason, why don't you kick things off for us today?
Yeah, thanks, Chris. Hi, everybody. So straight into unusually for me, I've got two long ideas today to speak about. So the first one is a company called JBG Smith Properties, so ticker JBGS, market cap's just shy of $4 billion, share price is around $30. As the name suggests, it's a property company. More specifically, they are an office stroke apartment real estate investment trust, so office stroke apartment REIT. They manage residential, office, retail and mixed use properties. They're fairly big. They've got about 11 million square foot of commercial space, which, as I say, is mainly offices. They've got 42 towers, 6,000 apartments. This is in the Washington, D.C., Northern Virginia and Maryland area. So to give you a bit more of background, so in their Q2, commercial space was basically 79% of their net operating income, and multifamily units was about 21%. Their biggest tenant, which is about a fifth of their rent, is the US government, and that's followed by Amazon, which is about 8% of their Q2 rent. Interestingly enough, which is relevant to the story, so in Q2, and I'll speak more on that subject of the Q2 results a bit later on, the occupancy in the commercial portfolio fell to just shy of 87% from 88.7% last year. And in the apartment portfolio, occupancy, as you'd expect, actually increased to 86% from 84.5% last year. And those numbers and what's going on with those numbers is relevant to what's behind the trade idea here. So just looking at as we always do, at the quantitative side of things first. So rather than looking at earnings per share as we often do, for property companies and REITs, the more relevant metric to look at here is something called FFO, which is funds from operations. So that's the basis on which I'm going to look at this company. So last year, the FFO was $1.19 per share. This year, that's growing to $1.49. And next year, that's predicted to grow to $1.67. So what we're talking about there is effectively 25% growth in funds from operations this year and 12% next year. Now, that compares to the sector average for office REITs of actually this year a continued drop of about 2.5% in the FFOs on average for office REITs this year, and zero growth next year. So clearly on that front, the company is outperforming. The company also, it trades on a 20 times FFO multiple for this year, compared to 15.5 for the sector, so a premium to the sector on that basis. And for next year, it's on 18 times FFO compared to 15.5 times for the sector, because the sector isn't predicted to actually increase its funds from operations for next year. And with property companies, we often look at the yield as well. So the dividend yield for this company is 3% as compared to 3.5% average for the sector. And lastly, on a balance sheet basis, on a kind of COVID impacted EBITDA basis, net debt for JBGS is around 6.8 times. And if you normalize the EBITDA, that drops to about 5.8 times. Now that compares to an average for the sector for office REITs of 8 times net debt to EBITDA. So clearly they've got a more conservative balance sheet. And just to finish off the quants, their net debt as a percentage of enterprise value is 32% compared to 44% for the average office REIT. Okay, so what's behind the idea here? As I mentioned, It's basically a transformation story. So these guys want to transform from being a predominantly office-based portfolio to a mainly apartment portfolio. So the idea is that more than half the portfolio will be consisting of apartment buildings. Now, why is that of interest? Well, one big driver here is that the average apartment REIT trades at a premium, a small premium to net asset value of about 1%, whereas the average office REIT trades at a 21% discount to NAV, which is indeed what JBG trades on as well. So these guys, they expect, in terms of their development pipeline, to develop 73% of their multifamily. They expect to develop 73% of the pipeline in terms of multifamily space, and only 27% in terms of office space. And their main development at the moment is this place called National Landing, which is I'm sure many of the guys following us in the US will have heard of National Landing. It's basically where Amazon are going to have their second headquarters. It's in suburban Washington, DC. And to pay for some of that, the management of JBG intends to sell off $1.5 billion worth of non-core assets, which will be primarily office buildings outside of the key submarket in DC. Now, that's important because this is one of the potential catalysts as well that will hopefully drive the share price up. So what might National Landing look like? What might a successful National Landing development look like? Well, we've got the first HQ for Amazon, which is at South Lake Union in Seattle, where they built their headquarters in 2010. There were lots of similarities between there and National Landing. So, for example, both of them are close to downtown central business districts, which is served by mass transit. Both areas have seen a lack of investment prior to the developments, which is now being encouraged with state subsidies, which is quite important. And by 2018, Amazon had brought in about 40,000 workers into that Seattle suburb, which is exactly what they're looking to bring into National Landing. And what that also tends to do is it brings in what's known as follow-on hiring by other tech companies that want to be part of the kind of tech ecosystem. So over the last 10 years, those buildings have basically got filled up. Rents have gone up 70%. I think that you could see rents potentially doubling over the same period for National Landing. Obviously, that's much more of a long-term story. In terms of what the management think, this is what the CEO had to say on the Q2 in the Q2 report. So he says, nobody has developed more in Arlington County, which is Washington, than we have in the history of the county. We are very well positioned to execute on this. If you look back at our track record and what we've done, we've got one project that we delivered on budget and on time. Every other project we've delivered better than budget and ahead of schedule. So we do have a tendency to underpromise and overdeliver. In terms of how much they dominate National Landing, they own 77% of the existing office space. They basically control it, which means that they can put up towers and fiber optic networks wherever they choose. In fact, last year, they spent $25 million buying 5G spectrum in the two counties where National Landing is situated. And they're building a data center nearby, which will also maximize the speed of mobile apps using 5G airwaves. And recently, just as of last month, they announced their intention with AT&T to make National Landing what they call the first 5G smart city. So those are the positives. Potential negatives. This company, even though it's $4 billion market cap, it's only got 3 analysts that cover it. And they've all got it as a whole, which you could see as an opportunity as well, because of course that means that there's potential for upgrades. To put that into kind of context, you'd expect a company of that size to typically be covered by 9 analysts. There's a few reasons for that lack of coverage. Number one, when the company went public, it did so via a merger and spin-off in 2017, as opposed to an IPO, which means they didn't have an underwriting syndicate, which means they don't have a load of banks covering it. Number two, because they've announced their intention is to shift into multifamily rather than office focus, that means that the office focus analysts that currently cover them know that one day this company is going to be taken off their list effectively. But at the moment, on the other side, the company doesn't currently have enough multifamily exposure to justify coverage by the apartment focused guys. So basically, they're kind of caught between two research pocket stools, as it were. And lastly, they've got a rather unusual approach to investor relations, or more accurately, they did, which was instead of earnings calls, these guys would issue detailed quarterly letters and publish long form answers to what they call frequently asked questions, which is a rather interesting approach. So on that, in that last earnings report, which was on August the 3rd, they had great results. This was their Q2. They beat on both top and bottom line by 45% and 27% respectively. And also in the last 30 and 60 days, the FFO estimates from the analysts for this year have all been moving up, which is obviously the right direction, which is effectively like an earnings upgrade. Catalysts. Well, they've announced, according to the CFO, the Chief Financial Officer, that there is an investor relations upgrade in the works. They want to, and this is to quote him, they want to make sure that the story is out there, and they're starting to do that. So hopefully they'll move to a more conventional approach to investor relations. Secondly, we've got positive news flow, for example, just like last month with them announcing the venture with AT&T at National Landing for the 5G tie-up. And then thirdly, where we might see positive news is them on the disposal front with these buildings that they're selling to fund part of the development, getting better prices and getting better cap rates than the analysts are currently expecting. So in terms of my trade structure, fairly vanilla. I've got a target price of $40. The current stock price is $30. I've gone relatively long dated because we've only got September and October expiries, and then we jump to January 2022. So I've gone long the January 2022 $30 strike for $1.70, which clearly means the break even's $31.70, only about 5-6% away from where we are. If the stock does go to my target price of $40, we're easily going to exceed that 3-to-1 win-loss ratio. The reason for not doing a calendar or a vertical is simply I'm not going to get much premium in at all for my $40 strikes.
Yeah, that's awesome. Very thorough analysis there. There's going to be loads to pick up on for you guys watching through that one. There's also things that are a little bit irregular to the normal kind of analysis, like you said, instead of looking at EPS, looking at FFO, was it, and things like that. Yeah. Awesome. Ben, let's go over to you. What have you been looking at?
Yeah, hi. Good morning. Well, this for me it is good morning on the West Coast. Yeah, so I have two ideas. My first is along, and it's pretty straightforward. It's maybe not as elaborate as Jason's, so I'll keep this kind of short and sweet. But semiconductors kind of overall has been an ongoing theme all year. We just saw it on the last PMI report that just came out today, actually this morning. The computer and electronics products segment, they're talking about their chip shortage is impacting the supply lines, and this is not a new thing. This has been going on for a while, but there are trading opportunities that has been created because of an imbalance between supply and demand in that area. So when COVID eventually loosens up and the supply lines, loosens up, this gets sorted out, you can get this huge influx of, the demand is already there, but these companies are not going to be able to deliver. So you're going to get a huge influx of potential revenue and earnings for just kind of the industry as a whole, or the sector as a whole. So the one I'm looking at in particular is ON Semiconductor, ticker is ON. It's kind of a mid-cap company, $19 billion market cap. The revenue is about $1.7 billion. What's a little different than the other semiconductors is that their primary source of revenue is automotive. Okay, so 33% came from automotive, 26% from industrial, 15% from communication, and only 15% from computing. So, and it's not only, when you think semiconductors for automotive, you think like electric vehicles, like Tesla and whatnot. But it's not only that. Okay, so yes, that's part of it, but the market we're in now and going forwards is any car, has a lot of computer stuff going on. And my wife has a little VW Beetle, and I think it's kind of a nightmare because every time something breaks, it's impossible to open the hood and figure out what's going on because it's always in the electronics. So, and that's just getting more and more the case. You have like sensor units, cabin monitoring, charger ports, traction inverters, viewing cameras, all this type of stuff that goes into all cars. And it's not only even cars, it's kind of day-to-day lives. Everything we do now requires more and more chips. So anyway, the technology inside cars is definitely getting smarter. Chips are going to be just more and more in demand longer term. And like I said, EV is one thing, but it extends beyond that. So looking at quantitative fundamental aspects, looking at the earnings estimates for this fiscal year, this company is firing on all cylinders. They have 190% growth, which is well ahead of their peer group, and their P's are reasonable at around 18. They reported 38% year over year and 13% quarter over quarter growth in the last quarter. And like I said, autos is a big part of the revenue stream. So 70% was from autos and 25% from industrial products, and then computing was also in strong demand. So this company is pretty much firing on all cylinders and also gaining strong market share in data centers. And I think based on what's going on in the industry as a whole and this whole and kind of the COVID lockup of deliveries, if you will, you're going to look at multiple expansions across the board pretty much in this area. And I think this company should get closer to a PE of 25, which is where it was last year. And that will give us price target longer term at a 70 based on 12-month forward estimates. Stock is now at 44 latest. Okay, so looking at another thing I like to look at is forward-looking earnings estimates for the next 4 quarters. And I like to see an increase across the board pretty much for the next 4 quarters. What I'm talking about is looking at how's the earnings estimate shifted in the past 1 to 6 months. And it's because it's this sensation of looking at changes. Yes, we want to buy or invest or trade a company with solid fundamentals, but that's not enough. You can take it a step further. And yes, fundamentals are solid, but it's a matter of, are they accelerating or decelerating? And, I like to see a company where everything is firing, where fundamentally the stock is doing better. Not only that, but they are also accelerating under the hood. And one way I look at that is I have on my TradeStation platform, on my charts, on the weekly chart, I have earnings, trailing earnings and trailing revenue overlaid on the chart, just to put it in context historically. And this chart I'm looking at here shows the trailing 12-month trailing earnings and revenue on top of the chart. Earnings is in green, revenue is in blue. Okay, so is earnings and revenue climbing? Yes. Are they getting better and accelerating? Yes. So those are kind of the things that I look at, and it's a matter of trying to put all the kind of the tailwind in your sales and have as much of the checks as possible and maximize your chance of success. So if you look at this stock going back to 2019, earnings momentum and revenue actually started slowing down, and the stock price is flatlined for almost 2 years. So it's kind of even though they're doing well now, but it's kind of a turnaround story also when you're looking back a little further back in history. So the catalyst specifically, besides, there's we talk about the chip shortage, which the current wait time in industry is now 14 weeks and is up 13 weeks And it was 13 weeks in January. It's not 14 weeks. And like I said earlier, it's been a major theme in the ISM reports. And now, in fact, almost 80% of chip companies are rising lead times. And you can say, okay, well, that's not really a good thing. Maybe not right now, but keep in mind that stock prices are not pricing in the present environment. Stock prices are pricing in 12 to 6 months in the future or beyond. And eventually, COVID will probably loosen up, and then you can get this boost for the bottom line in these companies. But this is not just based on the semiconductor kind of theme. At a company level, management is also looking to shift more into a direct sales model with more core customers, and also they're improving capitalized utilization, and they're releasing capacity for lower margin legacy products, favoring the higher margin products. So it's just more going on than just what you see on the in the ISM on the bigger view. Now, technically, this stock, I mean, as most of you know me, I do look at technicals. I use technicals to add to my fundamental view and help me with timing and selection of strikes primarily. So anyway, this stock has been in a pretty solid uptrend, and just recently it formed this kind of flag situation where what that means is the stock has had a huge move higher, and then it goes sideways to down, kind of pulls back in this shallow kind of wedge, if you will, over a few months, and then it breaks out of that. And quite often this kind of pause pattern indicates a halfway point in the move. This is kind of usually how it works out. So anyway, this stock is now breaking out of 45, and looking at this, I mean, I mentioned earlier 70 is kind of long-term target, but 50 is right around the corner. And for that reason, I actually got into this last week, looking at the chain here. I got into the October 45 strike at $2, and I sold the September 48 at 50 cents. So my cost is $1.50 per contract in diagonal spread. So the plan is that hopefully that short will expire worthless if the stock stays below 48 in September. And that at that point, I would look to potentially sell on October 50 to make it a vertical. And if I can get $1 for that, that will bring down my cost basis to $50. And it will leave me with a max profit of $450 per contract. So pretty decent ratios. So that's my long, and we'll see how it goes.
Yeah. I like that one as well, actually. I know that you're on the money with the sort of importance of the automotive industry to semiconductors. My brother works for Imagination Technologies over here, which is, you guys might know ARM better, that company, but it's like a smaller version of them, and they're basically pushing the automotive side hugely. So it's almost all they want to concentrate on at the moment, as far as I can gather. So cool, another interesting one. Jason, let's go back to you for your second long.
Yeah, thanks. So my second long idea is a company called Sonos, which I'm sure a lot of people are familiar with, tickers SONO, market cap $5 billion, share price 39.75. So, for the sake of thoroughness, what do? Well, as you probably know, they're a consumer electronics company, primarily specializing in manufacturing smart speakers. So they distribute their products in over 50 countries through a variety of channels. So they're selling their products through third-party actual physical stores, retail stores. They've got their own online platform, Sonos.com, and also they've got selected e-commerce retailers. So the speakers, include sort of things like home theater products and wireless speakers. You've got Sonos system products, which essentially covers the components that allow customers to transform third-party wired systems and home theater setups into wireless streaming music systems. You've got the partner products and other revenue business segment as well, which is kind of accessories that enable people to integrate devices that are manufactured or sold by their partners. So as I say, that they're present globally, mainly in the Americas, Europe, Middle East and Africa, and the Asia Pacific regions. They've also they're quite smart with their alliances. So they've got alliances with almost 100 streaming content providers, people like Spotify, Apple Music. They've got alliances with people like IKEA, or IKEA, I think is how the Swedes pronounce it. And maybe actually Ben can probably advise me on that.
IKEA.
Not Swedish, IKEA. Okay, thank you, Ben. And lastly, they've got this thing called Sonos Radio, which is free advertising supported streaming radio service, which features programming content from their streaming partners. So that's the background on the company. On the quant side of things, so they made a small loss last year of 18 cents per share. They're going profitable this year, so they'll be making $1.12 is the consensus for this year, and $1.19 for next year, which puts them on a PE ratio for this year of 36 times. That compares to the sector average of 27 times, so clearly, a fairly decent premium there in PE terms. They are on a PE multiple for next year of 33 times, which compares to the average in the sector of 25 times. So again, a healthy premium. Earnings growth this year, obviously, it doesn't make much mathematical sense to give it to you as a percentage. It's going from a small loss to making quite a bit. And then for next year, it's only 6%, which is basically what the sector is predicted to grow at for next year in terms of earnings. But I think that number comes up, and I'll talk about that later on. They've got a very conservative balance sheet with net cash on it. So, what's behind this idea? Number one, which I'm going to talk about in a bit more detail, they have a history of positive EPS surprises, and that, importantly, generally feeds into share price performance and appreciation. So you don't always get that, but these guys, they do have positive surprises, and it does get reflected in the share price. They're heavily invested in R&D, in research and development, which basically means that they're keeping up to date and ahead of the game on the technology front in both hardware and software. I think they've got a bit of a technological advantage. They've got intellectual property rights and patents around all of the wireless and audio technology stuff. They've got more than 1,000 issued patents, which gives you a clue of how much protection they've got out there, and I think that gives them the competitive edge. And interestingly, I mentioned earlier on as well the kind of partnerships and alliances that these guys have got themselves into. So although they are competing with big names out there like Bose, JBL, Harman, as well as the really big guys like Amazon, Google, and Apple, many of these guys are actually part of their partner network, which means clearly, then they're going to benefit from that as opposed to just being in raw competition with these guys. They've got a wide customer base, they've got significant market share, and they've got quite a lot of diversification, and they've obviously got pretty solid brand recognition. The growth strategy is multifaceted. So they are trying to, the intention is to expand their direct-to-consumer initiatives. They're also extending the partner ecosystem, and of course, trying to increase their geographical footprint, especially in Asia. Potential negatives. So these guys, they outsource their manufacturing to China, which is like a double-edged sword, because of course it gives them a competitive advantage on a cost basis, but of course we have seen supply chain disruptions, particularly in the kind of COVID era, particularly out of China. So that's a potential negative for these guys, and of course because they this is a research and development game, they need to allocate adequate and significant amounts to staying ahead on the technology side of things. So they've got to keep investing on the R&D side. Now, that last earnings report for them, which was actually their Q3, was on August the 11th. They basically did the trifecta, so they beat both bottom and top line, and raised the outlook for the rest of fiscal 2021. They beat expectations on revenues by 18%. So they came in with $379 million of revenue for the quarter compared to expectations of $320 million. And they raised the outlook, as I say. They're still focusing on 3 strategic initiatives, which is expanding the brand, the product offerings, and making operational improvements. So in terms of catalysts, not quite as specific as in the first trade example. What I'm looking for here is I'm looking for earnings upgrades, particularly for next year. I think that the analysts at the street have got those numbers too low. I'm looking also for price target and recommendation upgrades from the street. Now, in terms of my target share price, it's $50. As I say, the stock currently is around 39 3/4. Now, what I've actually done here is a pretty basic vanilla vertical spread. So I've gone long the December 2021 40-50 call spread, which is a cost per contract of $2.90. So you're basically getting into the 40 strike calls at 4.30. Selling the 50s at $1.40. It's not the most exciting strategy. It's not potentially as profitable as the first idea, but it's still giving me a respectable win-loss ratio. If the stock gets to my target of $50 and the break-even price is, not far above where we are, it's around 42.90.
Awesome, good stuff. I like that one as well. I'm a bit of a brand fan of Sonos, so collecting lots of their speakers.
I've got to say, Chris, I've made the same mistake of buying the going long of the stock of something whose product you actually like and own at home as well. A bit like Warren Buffett and his Coca-Cola.
Cool. Okay. Well, let's go back to you, Ben, for your final idea that you were looking at. Do you want to explain that?
Yeah. So speaking of trading companies that you use, I'll do the opposite. Okay, and I'm shorting a company that I definitely do not use, which is Robinhood. Ticker is Hood, recent IPO. And for those of you who have been living under a rock for the past year and do not know Robinhood, there might be some doubt it, but just in case, is a discount broker. They geared their business towards primarily small retail active traders, which in itself is not a big deal. They allow you to trade crypto, equities, and options in the same account, which they say it's a big thing, which is not. But also they are commission free and they make all their money on selling the order flow, which again, it's in itself is not really a new thing. I'll get more into that in a minute. But for Robinhood, they pass their order flow onto the market makers such as Citadel, and in turn to get paid for it. And what that does, and a lot of this happens in the financial business. Okay, there's huge conflicts of interest. So so the broker or Robinhood can end up on doing stuff that the market maker does not appreciate. So you think it's a free market, but in fact, it's not really. They launched an IPO this year at $38, and the stock quickly doubled. It's classic. People that trade Robinhood are a lot of the same people that actually use Robinhood. Stock went up to 80 some dollars. Then in August, it got cut in half. It's now back to around 43, and it's approaching the IPO price of 38. Okay, so the stock price is pretty much all over the place. I have a table here that shows the payment for order flow, where Robinhood compared to Charles Schwab and E-Trade was probably the biggest competitor in this space. And Robinhood from Q1 to Q2 doubled their revenue from payment from order flow, which in itself, you can argue that that's a good thing. And fundamentally, we don't have much data to go on because it's a fairly new company. But bottom line is, they had, so for the next fiscal year, they're actually forecasting, well, analysts is forecasting around 100% earnings growth over the next couple of years. But that's, it's so, there's so much that can happen in between. So I would take that with a huge bucket of salt. The company did, looking at the income statement straight from their website, they had operating expenses that tripled pretty much in 6 months. And they actually lost $8.41 share during the same time period. And it's not really unusual for a young company and a recent IPO to have wacky numbers. So again, that's not really the issue. So okay, so what's sort of the problem here? The problem is that when you have a company like this that is 100% dependent upon the payment for order flow practice, and their target customer are small, uneducated, active retail traders who kind of, these are guys who chase the latest meme stocks and crypto moves. That's the customer base. So in this past month in August, Bitcoin rallied about 20%. The rest of the market did pretty well. This stock was cut in half. So then my argument is, if this stock is, behaves like that in pretty much the best market environment you can expect, what will happen when the market turns? People lose maybe interest in Bitcoin, meme stock craze that's been happening this past year. Keep in mind, the whole meme stock thing is a new thing. Like me and Jason were institutional, traders back in the day. That you never heard about that. This is just like popped up this past year or two, past few years. And when all that hype dries up, this stock is going to have a really, really hard time. Okay, so I think it's going to be a huge roller coaster. Now, also, to add to that, just yesterday, the SEC started, voicing concerns about this practice as well, as it causes huge conflict of interest. So when they start, and if, and probably when, they start slapping on regulations in regards to these aspects, this company could have a really hard time, because they just don't have the client base to support a model that doesn't depend on payment for order flow, because that's what the whole company is built on. So I think this could be trouble ahead. Now the risk is, the main risk that I see here being short this company or short this stock is that they get bought out by a bigger, obviously a bigger fish, which has happened, seen it happen in the past. That could potentially happen. But that's why we trade options, right? So I'm not, saying I would short the stock for that reason. But with options, we can limit our risk potential. So we kind of just take that risk out of the equation. So what I did, stock is, well, when I looked at this, it was around 44. I'm long the October 40 puts at $4. Okay, and short the September 38 at $1.50. So again, this is a diagonal put spread. Total cost is $250. Quite often when these moves happen, the stock will, if it does get to 38, which I think it will, you will probably have support there. Okay, so you get people buying the IPO price. And that's why, one of the reasons why I chose 38 as a short strike, because I wanted stock to close above 38 at the September expiration, so that expires worthless. Now, it's really hard to come up with a kind of a price target on the downside, it's kind of like picking a straw out of a hat, like who the heck knows. But, any price below 38, things can just really start unraveling. And at that point, I will have unlimited upside on this trade going into the October expiration. So, that's what I have on that one.
I have to say, I really like that idea. Even at the current price, as you say, Ben, this thing got up to $85. Even where it is now, it's still got like a $40 billion market cap, which is just extraordinary when you think about it. I think also what in terms of what you're saying there about the PFOF rules. I mean, they actually even said in their pre-IPO filing that, and this is a quote from it, because certain of our competitors either do not engage in PFOF or derive a lower percentage of their revenues from PFOF than we do, any such heightened regulation or ban could have an outsized impact on our results of operations. I mean, that's specifically what you're talking about there.
Right.
Yeah, and then the other thing as well, I don't know, you probably saw this as well, Ben, that PayPal are also looking to muscle in, and they're going to allow their users to trade individual stocks. And apparently 91% of Robinhood customers also use PayPal. So, yeah, I think you're right there. I think the Prince of Thieves may have some problems.
Yeah, it's. I think that kind of to wrap it all up, I think the biggest issue with this company really is its client base, that they are primarily small, uneducated retail traders who just follows like the latest hype. And that's going to come back and bite them in the ass, for sure. Well, not for sure, but most likely.
Okay, guys, it's been a pleasure as always. We'll finish up there. I think there's been some great ideas to get the minds of our viewers churning today. So thank you both for coming on the show once again. Remember, for you guys watching, when these guys are talking through their ideas on the show, it's always within the context of their own portfolios. Okay, these won't necessarily translate to your own portfolios. That's not what this is all about. The purpose of What's on Your Mind really is to give you a sort of professional insight into how these guys come up with trade ideas and construct them as well. But if you were to sort of copy trade, who knows what would happen? It's probably a one-way ticket to losing money, purely because you don't know how to manage the trade. For one, you didn't put in the work to actually generate the idea. So just wanted to mention that, to make that clear for you guys. And in some more negative news, you've all missed out on the September War Room. So unfortunate for you guys as well there. But you'll be able to catch the next one. If you did miss out on this one and you wanted to go, don't worry, there probably will be another one in the future. So you can catch that. And in the meantime, of course, we've got a bunch of webinars at the Institute. Just go onto our website, itpm.com, and you can check out all the information about those and sign up if you want to. And of course, if you want to learn how to structure trade ideas and think about your sort of processes, as these guys do on this series, then you can do one of our educational courses or mentoring programs. All the information for all of that is on our website, so you can go and visit that in your own time and check it out. We'll also have What's on Your Mind in the meantime as well, so make sure you join us for the next episode, and I hope you enjoyed this one, and we'll see you then.